new Chancellor of the Exchequer, Mr Rishi Sunak, has unveiled his first budget, and his political and economic aims focused on helping the nation combat the COVID-19 outbreak, supporting economic growth, and implementing government policy of increasing opportunity for those who live outside London and the M25. Whether you think he's succeeded or not, I will leave up to you. Looking at the array of policies and initiatives introduced today, from the very narrow perspective of the stock market, investors seemed mildly impressed. The FTSE 100 index rose by around 1/3% during Mr Sunak's one-hour speech, although the index had already lost all the gains made thanks to the Bank of England's emergency half-point interest rate cut at the very start of the trading day. Preempting both Andrew Bailey's arrival as his successor on the 16th of March and the next meeting of the Monetary Policy Committee on the 26th, outgoing Bank of England Governor Mr Mark Carney took the base rate back to its record low of 0.25%. He also unveiled funding packages for small and medium-sized firms and eased balance sheet regulations on banks to give them the chance to lend more and cut some slack for borrowers who are struggling. To supplement this monetary policy response, Mr Sunak then came up with an easing of fiscal policy. He promised an extra £5 billion for the NHS as a starter, and £7 billion in targeted measures to assist companies and individuals with changes to rules on statutory sick pay and business rates, assistance with the time to pay tax mechanism, and government guaranteed loans for companies. Adding promised spending in areas such as housing, research and development, national infrastructure and education, and all told, Mr Sunak asserted the budget represented a fiscal boost of some £30 billion, or around 1.7% of national GDP. Now, the speech gave few details of how all of this was to be funded, especially as duty on fuel and wine, beer and cider were frozen once more. Although, a further clampdown on tax evasion is coming and, as expected, the previously planned cut in corporation tax to 17% from 19% was scrapped. No doubt the funding devils will lie in the funding details of the actual paper itself, so please take a look. Now, the Office for Budget Responsibility's forecasts were updated from last March, although they remain understandably subject to revision given the COVID-19 outbreak. Nor do the forecasts include Mr Sunak's fiscal largesse. However, the OBR did cut its near-term GDP and inflation forecasts, although the medium-term ones were largely unchanged, with economic growth running in the 1.3 to 1.5% a year range and inflation coming in at around the 2% target. With many of the fiscal initiatives targeting small and medium-sized firms, there may not be too much here for larger quoted ones to get too excited about, especially given the scrapping of the corporation tax cut. However, BT and Spirent have both taken encouragement from plans to invest in £5 billion in gigabit broadband and £510 million in 4G mobile networks, especially in rural areas. A plan to build 40 new hospitals is giving shares in construction and support services firm Kia a lift. Kainos, a specialist in providing electronic medical records and digitisation services to the NHS, is also up, although Medica, a provider of outsourced X-ray and radiology specialists, is down. Now, that may be partly due to the departure of its chief financial officer, although the company has been struggling to get enough staff to do scans for some time. So, more hospitals might not necessarily be a good thing for earnings if it can't increase the supply of trained radiologists quickly enough. Diageo is up a fraction on support for research and development in the Scotch whisky industry, while there are more notable moves at Balfour Beatty and Hill & Smith. The former had already got a lift from its full-year results out this morning, but the construction expert could be in line for more business as the government funds investment in rail networks, rail stations and over 4,000 miles of road. As a leading manufacturer of crash barriers for motorways, Hill & Smith will also doubtless be expecting to win its share of contracts too. Shares in Marshalls, which makes bollards and paving slabs used in rail infrastructure, also gained. One company which appeared to get a bit of a significant budget boost was book publisher Bloomsbury. It gained 6% on the news that VAT on digital books, as well as digital magazines for the record, would be abolished, potentially providing a boost to sales. JD Wetherspoon shares briefly reacted positively to the Chancellor's commitment to increase the business rates discount for pubs from £1,000 to £5,000, applicable for sites with a rateable value below £100,000 in England for 1 year from the 1st of April. The pub sector will also look to benefit from a freezing duty on all types of alcohol, although the challenge is really still getting punters to come through the door in the first place, amid increased pressure on people to stay at home during the coronavirus crisis. This might explain why shares in Marston's and Mitchells and Butlers largely shrugged off the budget announcement. Shares in house builders were also largely unmoved, even though the Chancellor promised £12.2 billion in grant funding for affordable homes across England. And also, the house builders weren't too moved by the revelation that the Housing Secretary is due to announce what he called comprehensive reforms of the planning system on Thursday. However, shares in affordable homes provider Galliford Try did jump on the news, and brownfield real estate developers St Modwen Properties is up, although Harworth is largely unchanged after Mr Sunak announced major regeneration projects, including some in the West Midlands. Thank you for watching, and I look forward to seeing you next time.